We are watching in real time the Fed push the dollar to its breaking point as we move through each FOMC meeting. And this week, we are beginning to see that dynamic develop yet again. And I want to lay out the different drivers that we are seeing taking place as we move into the FOMC meeting this week. To give you a little bit of context, we have had multiple FOMC meetings this year already, and we have a total of two left this week on Wednesday, and then also on December 10th. As we move into both of those meetings, there is already rate cuts with 100% probability being priced. That means as we move into those meetings, the entire question that all of us are going to be watching is how aggressive is the Fed going to be in allowing cuts to be priced next year? That's going to determine how much liquidity is going to get pushed into the system and thereby impact the S&P 500 and Bitcoin. And I'm going to break those down for you. As a quick side note, wherever you're watching this, below will be a link to all of the charts in this slide deck. And then there'll also be a full report breaking down how these different changes are beginning to take place, as well as all the educational material on macro. So the first chart that I want to start with is of the Fed funds rate, the 2-year interest rate, and the DXY. Now, one of the important things to understand when we're approaching the dollar, inflation, this whole idea of liquidity being pushed into the system is understanding what are the underlying drivers. Because you'll notice that in the chart, when we came into 2022 on the left-hand side of the chart, the Fed was rising and hiking interest rates on the short end. And this is why the 2-year interest rate was leading the way and beginning to push higher, which was also pushing the dollar up. And it pushed the dollar up against the euro, the yen, and all major currencies during that time, because when the Fed is pushing interest rates up, that is increasing the price of money in the system. When you rise interest rates and you push them higher, that begins to contract the amount of dollars in the system because financing gets more expensive. All of us intuitively understand how this works when you have mortgage rates rise, and then it begins to be harder and harder to buy a house if you're not making more and more money. That same dynamic functions in the entire global system with every single good, service, and asset. And so you'll notice that as we moved out of the hiking cycle and into 2023 and then 2024 in the middle of this chart, we began to see the DXY chop sideways as interest rates were oscillating in the range. And the entire question during 2023 and 2024 was, okay, the Fed is holding interest rates at an elevated level. When are they going to begin cutting interest rates? And as we moved into 2024 and then 2025, the entire question has shifted to when will the Fed cut into how much is the Fed going to begin cutting as we move into this period of time of cuts and the Fed beginning to ease its stance in monetary policy. The key logic that you want to be thinking about is during this time, if the Fed cuts too fast, they're going to push the DXY down, increase the amount of liquidity in the system, and then increase the amount of inflation risk. If the Fed doesn't cut fast enough, then they can increase the probability of a recession. And so we're really operating between those two tensions that exist right now. Now, the other dynamic that is on top of all of this is the Fed's balance sheet, which they have been contracting since 2022. And the chart here just shows the total balance sheet for the Federal Reserve. And we are in the process over the next 6 to 12 months of the Fed stopping how much they're rolling off their balance sheet and beginning to adjust and shift to more of an accommodative stance. And that's one of the things that everyone's going to be looking at as we move into the next 3 FOMC meetings. The way that we can begin to understand is the Fed cutting too much or too little, and how is that going to affect the currency and inflation and things like that, is by looking at underlying inflation. The chart here shows core CPI, which was one of the most important metrics to watch in terms of the connection to the underlying economy. So you'll notice that in the chart, in red, you see the services section of CPI, and it is decelerated in the most recent print. And then you'll notice in blue, the core goods service, or the core goods section of CPI, that's accelerated a little bit from tariffs and then some other changes that we have seen in the underlying economy. But broadly speaking, we are not seeing inflation accelerate, and we are actually seeing it begin to provide a little bit more support for the Fed to bring down interest rates. Now, the entire question we need to ask from there is, how fast is the Fed cutting relative to the amount of inflation in the system? And that is where understanding inflation swaps, especially on the short end, is going to be one of the differentiating factors for where equities and Bitcoin and things like that and assets across the risk curve are going to move. You'll notice that in this chart, we just have 2-year inflation swaps, and then in red and green is the rate of change of those inflation swaps. So you will notice that in 2022, on the left-hand side of the chart, we had elevated inflation, and you had inflation risk be very high as it accelerated, not only in the services section, but also energy prices. And then we also had all the geopolitical risks that pushed oil prices higher. As we came into 2024 and the beginning of 2025, inflation swaps began to rise and price in more inflation risk. And we even saw the curve bear steepen a little bit and some other changes that were indicating a higher degree of inflation risk. Over the last month or so, we have begun to see this shift a little bit. And this is a really key tension to begin to understand as we move into this FOMC meeting and also the December FOMC meeting, because the way that these forces begin to operate and move in tension with each other is going to determine if the Fed makes another policy error or they begin to adjust their stance in a durable fashion. And I'm going to lay out the tensions and the scenario analysis and signals for that in the report connected to this video. The key data point to understand for the dollar is real interest rates. So in the chart in white, you have 2-year real interest rates, which is showing how aggressive the Fed is relative to inflation expectations. So if inflation expectations rise and the Fed doesn't move, that causes real rates to go down. And what you'll notice over the last 12 months, we have seen real rates fall. Why is this? It's because the Fed has brought interest rates down as there is a decent amount of inflation risk in the system. So when you bring interest rates down and inflation risk is still relatively elevated, then you can begin to have more capital move out the risk curve. And you can begin to see the currency depreciate. This is a very typical and, I'd say normal thing that we see in history. Now, the question is, how far are 2-year inflation swaps going to fall as we move into December? That's going to determine how much capital we see get pushed into things like gold, silver, Bitcoin, equities, and everything across the risk curve. So when we have the Fed be too accommodative, you have the DXY typically depreciate, and you have, especially, over the last 3 months, you've had the ECB have more of a hawkish stance, and now they're shifting that as well, which is why we've seen a little bit of a bottom in the DXY. So we're in this range, compressing in the DXY, and that's why understanding how the Fed is going to operate in these new tensions is going to be the critical factor for how much of the credit cycle we have left and upside in equities we have left as we move into the end of the year. The other key point that I want to really draw your attention to is how the 2-year has been functioning. This is just the TU contract or the ZT contract on the CME. And you can go onto the CME website and pull any of the implied volatility that I'm showing here. You just go and search CVol tool CME, and it'll pull up these exact metrics. In the different data points that you see, especially in yellow, you have the implied volatility for the short end of the curve. When you have the interest rate volatility begin to drop and that begin to fall as you have less and less uncertainty and that hedging pressure kind of comes out, That, along with FX volatility falling, is one of the reasons why we have seen the S&P 500 begin to push up and Bitcoin begin to make a bottom and push up as well. When you have less uncertainty in the market around the distribution of where interest rates are going, that begins to allow people to take more risk, which is here in the chart of implied volatility for FX. You have also seen a massive crush in FX implied volatility, which helps different cross-border flows to move more smoothly and take more risk. Now, all of that is coming to where are we in the S&P 500 and how is that going to function? My view has been for a while that we are in a credit cycle. Ever since April, when I started writing Twitter threads, research reports on the Substack, and publishing videos on where we are in the credit cycle, we have seen one of the largest rallies in the S&P 500, in the Nikkei, in the DAX, in every single global equity index, because we are seeing both monetary policy and fiscal policy and commercial banks have a stance toward the system that is increasing the amount of money in markets and then also debt issuance in the underlying economy. So it's not surprising that we continue to see equities make all-time highs. My view is that the S&P will continue to push to all-time highs and likely the 7,000 level, which I've been laying out for paid subscribers on the Substack and really just buying dips and running the strategy that I have. But we are going to come to a point where the amount of liquidity in the system is going to be unsustainable because the Fed continues to push the dollar to extreme breaking points where you have issues with foreigners actually selling assets or selling equities because they have issues in either trade or the balance of payments or capital account. And I've laid out how to think about that on the Substack, which I'll link below as well. But there is going to be a point where the amount of liquidity in the system becomes unsustainable, and that will result in downside in equities and a bear market. We are not at that point yet, but when my strategy begins to shift and start flashing yellow signals and then red signals indicating, okay, I need to go neutral equities and then bearish equities, that is going to be one of the most important things to catch over the next couple years. We don't know when exactly it's going to take place, but we know the signals to watch for as these changes begin to develop. And that is also going to be on the Bitcoin front. We have seen a bottoming in Bitcoin, and my view is we're going to probably push higher and begin to adjust as capital moves out the risk curve. Now, as I said, all of these different changes we are seeing have different risks, and the way that I always approach markets is by being able to redundancy plan, because none of us understand the future. All we can do is say, what are the current drivers? How can I understand how those are changing? And then what are the different futures that could take place? One of the things that I always think about is not trying to make money on a single deterministic future, but be able to make money in any future that begins to take place. And how do you do that? You do that by understanding the signals that are developing in financial markets as it relates to how far is the Fed really pushing the currency to a breaking point. Not just that they're doing it, but how much. Because if you could know how much and the signals to look for around that, that is going to be the differentiating factor to be able to manage the cycle and the economic risks that we have in the system. So all of that is going to be laid out in the research report linked below. All of the educational primers are on the Substack for free. So I'll also link those below. You can go through the credit cycle playbook, the S&P 500 macro regime playbook, the Bitcoin playbook that I have used to run my Bitcoin strategy and to break down where we are on a big picture basis. And then a complete list of book recommendations that I always suggest to people if they're trying to understand the credit cycle and where we are on an overall basis. So all of that is there. And then obviously all of the educational primers are linked on the main page of the Substack. And then all the videos are on the YouTube channel as well. Those are the main points. I'll cover things further as we move into the FOMC meeting on the Substack. And then the report below will be linked explaining how I'm thinking about the S&P, bonds, and everything else as we move into this week.